mean, do you like the market at these levels? We're going on 7 straight up days. That's the longest streak since 2017. Do you think there's more fuel in the rally?
I think that equities are probably better placed than fixed income instruments right now. But really looking at the U.S. stock market today, it's kind of in that sweet spot where it's not overly cheap, but it's not terribly expensive. You've got the S&P trading around 17 times earnings, which is right in line with its long-term average, which suggests that basically companies or stocks should go up with earnings. Now, that said, earnings probably are going to be a bit more muted this year than they have been in recent years. For one, you're rolling off, you don't have the benefit of the tax cuts this year. And for two, I think one thing that could provide a headwind that might slow down earnings growth is the fact that in the fourth quarter, profit margins in the S&P were at historically high levels. If you normalize those, then that might actually slow that down a bit. But mid-single-digit returns is something that's not something to get excited about, but it's really the best we can find anywhere in the market relative to fixed income or other instruments.
Rick, what was the bond market's interpretation of the jobs number, and how do you explain the moves we saw?
We were live, obviously, Wolf, when the number was coming out, and immediately 2s and 10s. The whole curve, but 2s and 10s in particular, the yields spiked. They sold treasuries off almost right to the resistance level that traders were looking at as the breakaway point. So we were getting close to 238 in the 2s, close to 255.5-ish on 10s, but it stopped right where it was supposed to. There's a lot of clues in that. Anybody that was looking for lower rates panicked a bit. We get to see their hand. It's sort of a tell. And it acknowledges the notion that prioritizing those lows that were created all along the curve on January 3rd and lasted till about 3 weeks ago, they're very technically significant. So the number was a good number. But unlike last month where the headline number of 20,000, which was obviously revised up, that was bad. The internals were very powerful last month, whether you're looking at participation rates or employment to labor. All of that was better than this report, especially the month-over-month wages up 1/10. We didn't lose ground on wages, and I like when work weeks expand. Ed Lazier always says 1/10, and work weeks worth 400,000 jobs, but it hints that productivity might have paused a bit. So generally, Wilf, I think it was a C+, B- number, which is plenty good enough. The markets speak for themselves. They're just looking for an excuse in equities, in my opinion, to jump over current all-time highs, and most likely that excuse has to be something big, like a trade deal.
The other thing that happened today, Burns, is the president threw out the idea of quantitative easing, thinks that the Fed should be going there, and he's already called for them to cut rates 50 basis points. How do investors like you take those calls?
Yeah, I think there's a pretty wide divergence between what the economy needs and what the president's reelection campaign needs. I think that that's something that, again, with the president looking towards a reelection in the next 18 months, he probably is, as most presidents would, going to be focused on and wanting to see interest rates lower and easing in monetary policy. But at the same time, with the numbers we saw today, they don't really justify that. You see, it was kind of, again, in that middle ground. I think, Rick noted a B+, C- response, which is something that the stock investors kind of like at this point. It is a little bit Goldilocks, whereas it suggests that the economy is strong enough that you're not moving into recession, so you don't necessarily need to cut rates. But at the same time, wages were a little bit more muted, which means that you're not really seeing inflationary fears, so there's really no reason to raise rates either. It really allows the Fed to be patient and be data dependent going forward, but it certainly doesn't seem to indicate that we need to be cutting rates in the near term.
Rick, what's your take on the president's call this morning?
I think dropping rates is a bad idea. I think talking about crisis-era quantitative easing is a bad idea. But let's keep in mind, he tells us what he thinks. And just because he may tell somebody to jump in the lake doesn't mean we need to call the Coast Guard. I think we should debate that it's a bad policy idea. I think using that in the context of politics, I think Burns has it right. As a re-election, it's a good idea. I certainly didn't get the notion that he was putting out a presidential edict.
Yeah. So, Burns, let's talk about your picks. Healthcare, energy, and discretionary. What's the general idea there? It sounds pretty cyclical.
Well, I think that they're all, at least, we've seen an inversion or a near inversion of the yield curve, which suggests, I don't think it suggests we have a recession imminent, but it does really point to the fact that the economy is slowing down. And so in those cases, there's a couple of places to look for. One, you look for stability of earnings, and I think the healthcare sector certainly provides that. And then, coming from a different direction, you look at the consumer discretionary space. That's one that really, the discretionary stocks tend to be hurt as interest rates are rising, and that's what we've had in the last couple of years. But when interest rates go down, that helps discretionary names. We have clean consumer balance sheets. You have high consumer confidence and still lower unemployment. And so I think that's also a place that investors could look to for opportunities right now.